presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for August the 9th, 2022. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Let's start with this week, the Fed and inflation, the CPI numbers, the PPI numbers. We get all of those, and that will be the big event this week, how that's going to impact the market, and we're going to see how the market does. We saw the economic numbers come out last Friday. They were incredible. This economy is still moving right along. I'll take a look at the technicals. What are the chances of recession and outlook for the week ahead? Let's start with this week, the Fed. You can see that inflation numbers are expected to come out tomorrow. Expected CPI tomorrow is at 8.8%. That's the expectation. A number higher than that, it's going to be bearish for the market, because that'll put more pressure on the Fed to raise interest rates even further. The PPI, or the core, is expected to be at somewhere right around 6.2%. That's the core rate. So it is expected to go up slightly. So we will see how these numbers come out. Again, it all depends on how the inflation numbers come out. And if inflation is peaking, and that is the expectation, that it's going to start falling off just fractionally tomorrow. Oil prices are down, commodity prices are down. That should put some downward pressure. But we're also seeing shelter prices, which is a big contributor to the CPI. That is rents. They're going up dramatically. So we will see how the lower gasoline prices, how much of that is negated by the higher rent prices, and what number we get. If we get a number higher than 8.8, then there is a possibility the Fed will raise interest rates in September on their September 20th, 21st meeting by another 0.75%. The market, I think, is ready for about half of 1%. As I mentioned last week, the market got a little bit too excited with the numbers, and then we get the unemployment number, which was much better than expected. So I think the market has moved up. We need some backing and filling in the market. Here we are starting to see the Fed. It has increased the amount of bonds that it held. It has continued to go up, but now it's starting to taper off a little bit and starting to come back down, which is they're letting the bonds mature at $50 billion a month, and they're going to increase it to about $95 billion a month. And that's what they will be looking at and thinking about right now. And that's what if they let it go by about $100 billion a month, that is taking $100 billion of liquidity out of the system. So we will see how that works. Looking at the market, bear markets have bottomed before the ends of recession. We're not even in a recession. Was this just a slowdown? Will the recession come next year? We don't know that yet. But as I've said, with the unemployment rate at a 50-year low, people are still spending. And as long as people are spending, consumption is going up. And that's when companies can increase prices, they can maintain their margins, and that's what we've seen. But the bear markets usually end a few months before the recession ends. This is the end of the bear market, this is the end of the recession, and you can see the market anticipates that the recession is coming to an end and the markets take off. We're not even in a recession yet, but the expectation, the markets last week started to expect the Fed is going to take the foot off the brake and raise interest rates less. I don't think they do that anytime soon. We're looking at the exhibiting some of the strengths that we're seeing. We've seen energy markets go straight up. They're starting to come back down. Utilities are still going up, but materials are starting to fall off now. And we're looking at certain sectors, technology, which was going up nicely until end of last year. Then it fell off. It is starting to gain some momentum. And we're seeing communication services, that's Meta and Google and things like that. They're starting to come back. Consumer discretionary, which peaked again right at the end of last year, has been coming down. But they were starting to see some movement to the upside. We had 578,000 jobs created. That was more than the expectation of about 250,000 jobs. So we more than doubled the number that was expected. So as I've changed the saying, the old saying was, look, well, when your neighbor lost a job, it's a recession. When you lost your job, it's a depression. I've changed it, and when your neighbor loses a job, it's a slowdown. When people lose their jobs, then it's a recession. We are at a 50-year low, so the Fed still has room to raise interest rates and slow the economy down, which they're going to continue to do. Looking at labor market, again, remarkably strong. June number was 398, and the July number was 578. So we're still way ahead of what was expected. We've seen wages also going up with gasoline prices. People were concerned about gasoline. It's dropped nearly $1 a gallon now about throughout the country. So we're seeing some easing of oil prices with the oil flows going in different directions. Russian oil is going to China and India. Middle Eastern oil is now going to Europe. It used to go the other way around. So we're seeing the change. But the natural gas price is going to be a problem for Europe later on this year. Looking at the technicals, we've seen the 10-year note interest rates peaked right about here, about 3.5%. That was in June. Since then, we've seen interest rates come down about nearly a full percentage points from here to here. This is the 10-year note. We've bounced back up. Resistance is right about here at about 3%. So that's where we are going to see if the rates go above that or not. I think we are in for a little bit of a bounce, then another decline, and we could come down to 2.27 depending if inflation has peaked or not. Daily chart, here's the technicals for the dailies. This is a daily chart. This was interest rates. This is S&P. Resistance is 43.33, 200-day moving average. Support is the 20-day exponential, which is at 40.39. We're at 41.22 today, going into the close. And then the 50-day is 39.46. I don't want to see the market get below this number. If it does, then this whole thing, this 1, 2, 3, 4, 5, it cancels, it becomes an A, B, C correction, and then we start heading towards these lows right here, 36.36. If we break 39.46, if we just come down to these levels, start going up, which I think we will, then we could be heading towards 4,200 plus. Again, here's the 20-day, 20-week moving average, which is right around 40.79. We are today trading at 41.24 or so, right around 41.25. So we can go down another 40, 50 points and still hold support. I think we will do that. That's the backing and filling that we're getting. Nasdaq is the one that I like to see leading on the upside and the downside. We've got wave 1, 2, 3. We're getting a fourth wave correction. Support again, 12,032 or so, then 11.7. That's what they're looking at, and resistance at the 200-day, which is 13.5. Again, we made a third wave. We're going to get this fourth wave pullback. Hopefully going to bring us down to about 12,000 plus or minus. We're at about 12.5 today. Move above, come back here and then bounce up. Then we could head up. If we hold 12,000, then we could go up to about 13.5. Bigger number. This is one chart I want you to pay particular attention to. It is, you see these dots. When the market is above these dots, this is the market, these vertical lines, and these are my dot plot. When the market gets below it, this was the March 2020 decline. Then you got above it right here in about April and May. And you can see that the dot plot has remained positive all the way through January of this year. That's when the dots get above the market. That is usually a bear trend on a weekly basis. And we continued down until the last week, where the dots have come down now. We have to get below 10,565 for the market to turn negative. 200 week is about 11,000. We are at about 12.5 today. As long as we hold this, then pullbacks, I think in the Nasdaq, even at 12,000 or 12,160, is a buying opportunity. Long-term trend, the weekly trend has turned up. That is a good sign for the first time this year. We turned down at the beginning of this year. Now we've turned back up right here. The dot plot is below, the market is above. That is a positive indication for the market. I think depending on, we've got August and September. Those are usually bad months for the market. We could bounce around here for a little bit and then take off to the upside. That is the way I'm looking at it. But we have to hold 11,000. Our stop should be somewhere right around here, around just below 12,000. So if you want to participate in the Nasdaq, put stops below 12,000 if you're totally out of the market. If you're in the market, you have the right allocation, which you should have, then you're sitting comfortably, wait, pullbacks, that's where you start adding some of the money, but wait for those pullbacks and see how deep those pullbacks are before you start to add. Crude oil broke below the 200-day moving average, which is at 95. Today we are about $90.50 a barrel. Resistance is the 50, which is 105. I think we'll be somewhere around here, around 85 to 105 is the window we are going to trade in as far as oil is concerned. Gold made this low, rallied up. It's at the 200 days, 1841. We're at 1811 today. I think support is 1790, then 1748. As we get closer to September, the expectation is the Fed is going to raise by 3/4 of a point, and that will be negative for the gold market. When interest rates go up, dollar goes up. When the dollar goes up, gold goes down. That is the correlation usually, and I don't see interest rates coming down anytime soon. I think the market has gotten ahead of itself a little bit and expecting interest rates to start coming down next year. I don't think the Fed is going to continue to raise and let them sit there for a period of time until we see below trend growth, that is below 2% GDP growth, and the unemployment number goes up. Unfortunately, that is going to be terrible for some people, but we have so many jobs available that I think we have to have more slack in the labor market before we can say that inflation has bottomed. Looking at the market meter, I think the chance of recession this year dropped to about 45%. I had it at 50, but with the unemployment as strong as it is, I think we're down to 45. Outlook for the week ahead, we are going to see exactly how the inflation numbers come out and how the Fed reacts. Those are my views. Those are my thoughts for August the 9th, 2022. Again, if you need help with your portfolio, just go to compak.com. We'll develop a plan for you. We'll show you what we do, how we do it. compak.com. Thanks again, and see you next week.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.